Ever wondered how the rich manage to pay less taxes than the rest of us? It's a question that stirs curiosity and frustration in equal measure. Today, we're delving into the intricate world of tax avoidance strategies that the wealthy employ. We're not just talking about the occasional deduction here and there, we're talking about a complex network that keep their tax bills astonishingly low. So stick around, because by the end of this video you'll have a clearer understanding of these strategies. And don't forget to like, subscribe, comment, and share this video. Before we delve into the secrets of the wealthy, we must first understand the basics of taxes. Taxes, in essence, are mandatory financial charges levied by the government to fund various public expenditures. The tax system is intricate and varied, but for now, let's focus on three primary types: income tax, capital gains tax, and estate tax. Firstly, let's talk about income tax. This is the tax you pay on the money you earn from your job, sometimes referred to as salary or wages. It's typically a progressive tax, meaning it's based on the ability to pay. The more you earn, the higher your tax rate. For example, a person earning $50,000 a year will pay a lower percentage of their income in tax than someone earning $1 million. Next up is capital gains tax. This is the tax on the profit from the sale of an asset like stocks, bonds, or real estate. If you buy an asset and then sell it for more than you paid, the profit is called a capital gain, and it's subject to tax. Capital gains tax rates are typically lower than income tax rates, which is one reason why investments are a popular way to build wealth. Finally, we have estate tax, sometimes called inheritance tax. This is a tax on the transfer of an estate of a deceased person. In many jurisdictions, estate tax is only levied on estates above a certain value, meaning it primarily affects the wealthy. These three taxes, income tax, capital gains tax, and estate tax, are the primary taxes that wealthy individuals aim to minimize. They form the basis of our tax system, and understanding them is crucial to comprehending the strategies the wealthy use to reduce their tax liabilities. With this foundation, we can now explore how the rich navigate these taxes. The system is riddled with loopholes that the wealthy exploit to their advantage. What exactly are these loopholes? Picture them as tiny escape hatches in the vast and complex tax code. They are often constructed by the tax law itself, or are the result of the interplay of several laws. While they're legal, they're often used in ways that the creators of these laws didn't originally intend. Take, for instance, the carried interest loophole. This is a provision in the tax law that allows managers of hedge funds and private equity funds to treat their income as long-term capital gains, which are taxed at a much lower rate than ordinary income. Even though they're providing a service and being compensated for it, much like anyone else who works for a living, they get to pay a substantially lower tax rate. Then there's the estate tax loophole. This allows wealthy individuals to reduce the value of their estates, and thus the estate tax that their heirs would have to pay when they inherit the estate. They do this through various means, such as by setting up trusts or by gifting their wealth during their lifetime. And let's not forget about the step-up in basis loophole. This is a rule that allows the wealthy to avoid paying capital gains tax on assets that have appreciated over time. When these assets are passed on to heirs, their basis, or the value from which the gain is calculated, is stepped up to the current market value. This means that the gain that occurred during the original owner's lifetime is never taxed. These examples illustrate how the tax system can be manipulated to serve the interests of the rich. It's a game of financial hide and seek, where only the players with the most resources and the best advisors can truly win. These loopholes, while legal, are only the tip of the iceberg. When we talk about tax avoidance, we cannot ignore the role of tax havens. So what are tax havens? In essence, these are countries or jurisdictions with very low tax rates or no taxes at all. They are basically financial sanctuaries where money can be stashed away from the prying eyes of tax authorities. Tax havens work by offering individuals or corporations confidentiality and the opportunity to reduce their tax liabilities. This is achieved by setting up shell companies or offshore accounts, which are essentially businesses or bank accounts that exist only on paper, with little or no actual operations in the tax haven itself. These entities are often used to hold assets or conduct transactions, effectively shielding them from taxation. Let's take a look at some popular tax havens. Switzerland, known for its strong banking secrecy laws, has long been a favorite destination for those looking to safeguard their wealth. Swiss banks offer a high degree of privacy, making it difficult for foreign tax authorities to trace funds back to their owners. The Cayman Islands, a British overseas territory in the Caribbean, is another well-known tax haven. It imposes no income tax, capital gains tax, or corporate tax, making it an attractive destination for businesses and wealthy individuals. In fact, it's estimated that the Cayman Islands is home to more registered businesses than people. Then there's Luxembourg, a small European nation with a big reputation as a tax haven. Luxembourg offers a range of tax benefits, including low taxes on corporate profits and lenient regulations that allow companies to shift profits to the country and reduce their overall tax burden. The use of tax havens is a common strategy among the rich. By exploiting these tax-friendly jurisdictions, they can keep a larger portion of their wealth, often at the expense of the countries where the money was originally made. It's a complex and controversial issue, one that continues to shape the global financial landscape. Beyond loopholes and tax havens, there are several other strategies the rich use to reduce their tax bill. Let's kick things off with deferring income. This is a strategy that involves delaying receipt of income or bonuses until the next tax year, when they may be taxed at a lower rate. A simple example would be an executive choosing to receive a year-end bonus in January rather than December, effectively moving the income into a different tax year. Next up, we have the conversion of income into capital gains. In many countries, capital gains are taxed at a much lower rate than regular income. So what do the wealthy do? They convert their income into capital investments, like stocks or real estate. When these investments increase in value, the profit is considered a capital gain, not income. This way, they're taxed less when they sell their investments. Now let's talk about trusts and foundations. These are legal entities that can hold and manage assets on behalf of an individual or a family. By transferring assets into a trust or foundation, the wealthy can effectively reduce their taxable income. Plus, these entities often have their own tax benefits, such as lower rates or exemptions. For example, a charitable foundation could be used to reduce taxable income while also supporting a cause close to the individual's heart. These tactics are not for the faint-hearted. They require careful planning and expert advice, and it's worth noting that while these strategies are legal, they're also controversial. Critics argue they allow the rich to avoid paying their fair share, exacerbating income inequality. But whether you agree or disagree with these strategies, there's no denying their effectiveness. After all, they're used by some of the wealthiest individuals in the world who have some of the best financial advisors at their disposal. These strategies, while complex, are effective at reducing a wealthy individual's tax liability. So what can we learn from the tax strategies of the rich? The takeaway from our journey into the labyrinth of taxation is that understanding the tax system is crucial, no matter your income bracket. We've explored the basics of taxes, from how they're structured to why they're implemented. We've delved into the loopholes that are exploited, revealing the intricacies of tax law that allow for such opportunities. We journeyed to the tax havens, places often painted as idyllic getaways, but in reality they're strategic points in the global financial web. These locations offer lower tax rates, encouraging the rich to store their wealth and potentially avoid higher taxes in their home countries. We've also unpacked the strategies employed by the wealthy. Ingenious, some might say, controversial, others might argue, but these strategies are a product of the system that's in place, a system that often seems to favor those at the top. The rich have the resources to navigate this complex system, to understand its intricacies and to exploit its loopholes. They employ a team of experts who use their knowledge to minimize tax liabilities. But it's not just about understanding how the rich avoid taxes. It's about appreciating the complexity of the tax system and recognizing the need for reform. It's about striving for a system that is fair, equitable, and transparent. While most of us may not have access to these strategies, understanding them can help us appreciate the complexity of the tax system and the need for reform.